Okay, let's see if this helps. I've got an example here from chapter 3. I don't recall what problem number it is, but in this situation, we've got a company that has pre-tax book income of this. They acquire an asset, and the first year tax depreciation exceeds book. It's supposed to be book depreciation by 80,000. So we have more of a tax deduction on the return than we have for book purposes. They have no other temporary or permanent differences. Assume a tax rate is 35%, and compute the current income tax expense, the deferred tax expense, and also the total income tax expense. I think the best way to get at all three of these is to go through this kind of a process every time. You start off with book income, and you consider any permanent differences that you might have. In this case, there are none, so we don't have any to consider. But sometimes there might be, let's say, interest income on a municipal bond. That's not taxable. So since that income would be included in book income, we would get it out right here. Okay, so we don't have anything like that in this problem though, so we have none. And so we then have a book income after perms of $500,000. The total tax expense is just this number times whatever the tax rate is, in this case 35%. So this is the total expense. Now what we've got to do is figure out the current piece and the deferred piece. So the current piece is going to tell us what we expect to pay in taxes this year. And the deferred piece will tell us, or is recording, what tax expense do we expect in the future because of anything that exists this year that we know that's going to flip. And in there, we're talking about temporary differences. These are items that have different rules for book purposes and tax purposes as to timing. Um, Basically, this means that some items might be income for book purposes in a year that they're not income for tax purposes. They'll be taxable income later on. Or maybe you've got expenses that are a book expense this year, but they won't be tax deductions until some future event happens. Or the reverse can be true in both of those cases. In this case, we have depreciation where we have tax in excess of book depreciation by 80,000. Well, book depreciation is already buried in this book income number. This is profit on the income statement. So book depreciation expense is already there. We have to deduct an additional 80,000 in this scenario. That takes us to our current year taxable income of 420 times the tax rate. We expect to pay 147 on our tax return this year, our federal tax return. Um, the deferred piece is saying what is going to happen in the future because of the events, the temporary differences that exist this year. Because we have a reduction in tax this year, this $80,000, we are going to expect to pay more tax in a future year whenever book depreciation exceeds tax depreciation. Because we know depreciation for the life of an asset is going to be the same for book or tax. It's just when does that depreciation get recorded. You have straight line for book, double declining balance method for tax. That means you have different amounts per year, but in total it'll be the same. So eventually this 80 will flip and become an increase to future taxable income. Well, that's going to cause, at 35%, $28,000 in future taxes to be paid. The matching principle says we have to record the future impact of this year's events in this year. So you match expenses with the periods they relate to. So this is matching a future expense with the period that caused it or that it relates to. So our current tax expense is 147. The deferred is 128. You add those up, you get your total of 175. So it always is going to work this way, that the temporary differences will have one effect on the current tax expense and the opposite effect on the deferred tax expense. You could have a situation where you're adding 80,000 to taxable income this year because book exceeded tax depreciation. So you won't be able to deduct as much for tax purposes. In that case, you would add 80 here, end up with 580. You'd have even a bigger current tax expense, and you'd have a deferred tax benefit because you'd be expecting future taxes to be less because you paid more this year. All right, so I hope this helps. As always, send me emails or discussion board posts if you have more questions.